G'day Gain Squad, it is Goldie Gains here. The entire global energy market was staring down a total collapse at 8 p.m. Eastern Time on Tuesday night. The world was holding its breath for a massive conflict, but a shock 2-week ceasefire just changed the entire game. Today we are unpacking the massive crash in oil prices, the gold safe haven shift, and some wild tech swings. We will dive into why the US dollar index hit a 4-week low and how the tech giants are holding up. Plus, I will show you where the smart money is hiding while the market is in turmoil. Just a quick reminder that I am not a financial advisor, so please do your own research before trading. So traders, the big question is, do you think this 2-week truce is a real deal or just a massive bear trap? Drop a comment with your thoughts, smash that like button, and subscribe to the Goldie Gains Squad right now. Let's see where the smart money is flowing today, because the last 72 hours were mental. The smart money over at WallstreetBets is currently buzzing about a massive technical reversal for the history books. Some of those traders reckon we are seeing the most brutal metals and crypto crash ever recorded in modern times. There is a popular theory on Reddit that Gulf state sovereign wealth funds have been dumping their gold recently. They might be liquidating assets like gold and tech stocks to meet massive budget shortfalls caused by the war. One top commenter mentioned that this is distress pricing and represents a proper golden entry for long-term bulls. Others are warned that the recent bounce is just fake pumping before a much larger recession hits us in mid-2026. They are keeping a close eye on the $10 trillion in US Treasuries that must be rolled over soon. If no one buys those bonds, the Fed might be forced to hike rates, which would be a total dog's breakfast. But for now, the vibe is cautiously bullish as everyone tries to figure out the next major catalyst for bullion. Let's jump back to April 7th, when the tension in the Middle East reached an absolute boiling point. President Trump had issued a terrifying warning that a whole civilization could be wiped out if the strait wasn't opened. Everyone expected the worst, and oil prices initially spiked as traders scrambled to hedge against a total war scenario. But then, out of the blue, Pakistan and other mediators managed to squeeze out a last-minute ceasefire agreement. The deal includes a 2-week pause in military actions and the reopening of the crucial Strait of Hormuz for shipping. As soon as that news hit the wires, the peace trade took over and sent shockwaves through every major asset class. It was a classic buy the rumour, sell the fact moment that caught a lot of short sellers completely off guard. The relief was palpable across the global markets, but the underlying geopolitical risks are still lurking in the background. Even though a truce was signed, there are still reports of localised strikes that are making the market nervous. We are not out of the woods yet, but the immediate threat of a global energy shutdown has definitely eased. Speaking of energy, the price of West Texas Intermediate oil took a massive dive once the truce was confirmed. US crude futures plunged 14.3% to settle at $96.83 a barrel. That is a massive drop from the $113 peak we saw just a few hours earlier. The international benchmark, Brent crude, also took a hit, falling over 13% to settle near $95. This collapse in energy costs is a huge relief for the global economy, but it creates massive volatility for us. The CBOE Crude Oil Volatility Index, or the OVX, shot up to an eye-popping 98.79. That level of volatility is nearly quadruple the typical range we see during more peaceful times in the market. High OVX levels usually mean the market is still skeptical about how long this energy supply will actually last. If the OVX stays this high, we can expect some proper wild swings in gold and currency pairs this week. Now let's look at the shiny stuff, because gold took off like a rocket on news of a ceasefire. On Wednesday, April 8th, gold initially surged to a 3-week high of $4,850. The move was fueled by a massive sell-off in the US dollar index, which hit a 4-week low of 98.9. But as the risk-on sentiment grew, traders started taking profits and rotating their capital back into the stock market. Gold gave back a big chunk of those gains, pulling back to settle around $4,709. It is currently sitting in a neutral zone as the market digests the news and waits for the next day to drop. The decline in oil prices has cooled some of the immediate inflation fears that were supporting the high gold prices. But the structural demand from central banks is still providing a very strong floor for our favourite yellow metal. Even with the intraday dip, gold is still up more than 50% over the last 12 months of trading. We are seeing a bit of a transition from gold as a war hedge to gold as a monetary hedge. The US dollar index, the DXY, has been acting quite firm despite the initial plunge after the ceasefire announcement. It is currently holding near 99.10 as safe haven demand remains steady late in the American session. This dollar strength is mostly due to the FOMC meeting minutes that were released on Wednesday, April 8th. Those minutes revealed that Fed officials are still very worried about inflation staying way too high for comfort. They reinforced a higher for longer stance, suggesting that rate cuts are definitely not coming anytime soon in 2026. In fact, some policymakers are worried that the Middle East conflict will keep energy prices high and fuel more inflation. This hawkish tone is putting a bit of a dampener on gold, since the metal doesn't pay any interest yield. It is a tough environment for the gold getters, but we are looking for those long-term structural trends to stay intact. Over in the US equity markets, the Magnificent Seven tech giants had a bit of a rough trot this week. Apple shares actually plunged 5% at one point due to rumours of issues with their new foldable phone. But they managed to bounce back after a report confirmed they are still on track for a September release date. The overall Magnificent Seven index only managed to edge up 0.01% during the Tuesday session. Alphabet was the standout performer, gaining 1.8%, while Amazon and Meta saw very modest gains. Tesla and Apple were the laggards, both closing in the red as investors rotated into smaller tech companies. We are starting to see a real shift where the big boys aren't leading the market higher like they used to. This rotation is why the S&P 500 and the Nasdaq only eke out very tiny gains on Wednesday. Traders are becoming much more selective, looking for value in the other 493 stocks. If the AI narrative starts to fade, we might see even more capital flowing back into hard assets like bullion. The sentiment on the ground is still quite jittery, and we are seeing some high-volume selling during any price spikes. It feels like the market is waiting for a reason to break out or break down, keeping us all on edge. But for the smart money, these periods of consolidation are the best times to find a proper golden entry. Looking ahead to Thursday, April 9th, we have some massive economic data coming out of the United States. We are waiting on the core PCE price index and the final GDP numbers for the last quarter of the year. These reports will give us a clear picture of how much the war has actually impacted the American consumer's wallet. If the PCE numbers come in hotter than expected, the US dollar will likely catch a massive bid against everything. Gold could take another hit if the inflation data forces the Fed to stay even more aggressive with their rates. We are also watching the weekly unemployment claims to see if the US labour market is finally starting to cool off. It is going to be a flat-out session, so make sure you have your stop losses set and your plan in place. The consensus among the Reddit traders is to buy the dip and not let the short-term noise rattle your cage. They have seen these geopolitical head fakes before, and they know the long-term debt story hasn't changed a bit. The US budget deficit just hit $1 trillion for the first 5 months of the fiscal year, which is mental. That level of spending is eventually going to weigh on the dollar, regardless of what the Fed says today. For us gold getters, it is all about staying patient and waiting for the market to give us the right signal. I am seeing a lot of accumulation in the gold ETFs, which suggests institutional money is still moving in slowly. Total global gold holdings have actually picked up since early April, hitting the highest levels in several weeks. This tells me that the big players are using these dips to build their insurance policy for the rest of the year. Don't let the Bloody Tuesday headlines scare you away from a solid long-term investment strategy, mate. The market is just doing its thing, shaking out the weak hands before the next leg of the bull run. If you look at the price performance, gold is still outperforming the S&P 500 by a massive margin lately. While the tech stocks are struggling with lofty valuations, gold is consolidating near its recent historical highs. We are seeing some emergency selling from certain central banks, but other liquid banks are buying every pullback. It is a massive tug-of-war between short-term liquidity needs and long-term currency diversification strategies. Our job is to stay on the right side of that flow and not get caught up in the emotional roller coaster. I'm feeling pretty stoked about the current levels, as they offer a much better risk-to-reward ratio than last month. Let's optimize this entry by being disciplined and not chasing those green candles when the FOMO kicks in. The ceasefire might have taken some of the heat out of the market, but the fire is still burning under the surface. We are keeping a close watch on the localized airstrikes in the region, as they could break the truce anytime. If the Strait of Hormuz gets blocked again, you can bet oil and gold will be back at record levels in a flash. Until then, we play the range and look for those key technical signals to guide our daily trading decisions. The US dollar index near 99.10 is the main one to watch for a break in either direction. If it falls below 98.5, gold will likely have a massive rally back toward $5,000. But if the dollar strengthens back above 100, we might see gold test the support levels once again. It is a high-stakes game of chess, and we are just trying to stay one step ahead of the grandmasters. The smart money is already looking past the ceasefire toward the next major inflationary energy shock in April. Make sure you are positioned correctly and not over-leveraged in case the market takes another wild turn tonight. This is the time to stay focused and keep your emotions in check, regardless of what the news cycle says. We are all here to make some gains, but preserving your capital is always the #1 priority in this game. It has been a shocking week so far, and I don't expect the excitement to slow down anytime soon. Keep your wits about you, stay active in the markets, and let's see what the next close brings us. Let's optimize this entry by checking the daily chart where gold is holding the 21-day simple moving average. That level is sitting right at $4,672 per ounce today. The relative strength index is a neutral 49.5, so we aren't in the overbought danger zone yet. But watch out for the 50-day exponential moving average at $4,796. It is currently acting like a heavy ceiling that the bulls are struggling to smash through this week. The Bollinger Bands are also squeezing tighter than my morning coffee budget, which usually means a big breakout. On the 1-hour chart, the 9-period simple moving average is acting as dynamic resistance, keeping the price down. If we break below 4,650, the market's having a bit of a wobbler toward lower levels. To summarize the chaos, oil prices crashed 14% after the surprise 2-week ceasefire was signed on Tuesday. Gold hit a 3-week high near $4,850 before pulling back to consolidate. The US dollar index hit a 4-week low, but the hawkish Fed minutes helped the greenback find its footing. Tech giants like Apple and Tesla underperformed, while Alphabet and Amazon managed to stay in the green for now. WallstreetBets is shouting to buy the dip, seeing this as a temporary shock in a long-term bull market. Volatility remains sky-high with the oil VIX near 99, showing that the energy market is still very nervous. Our technicals show a neutral range for gold, with $4,700 acting as the main psychological floor. So gold getters, do you reckon the Fed's higher for longer talk will finally be the thing that breaks gold's back? Or is the US debt story too big to ignore? Let me know in the comments below, and don't forget to subscribe. Smash that like button if you found this update useful, and tell me where you think the smart money goes next. This is a proper golden entry. Keep your positions tight and gains golden. I'll see you at the next close. Cheers.